Hey everyone, thanks so much for joining us today. My name is James Osborne with Envest Asset Management. I'd like to say thank you to the Connecticut Sustainable Business Council and Conscious Capitalism Connecticut for putting on this Climate Action Business Summit. Our company is a proud member of the Connecticut Sustainable Business Council, and we also are a B Corp. And you may have seen other panelists talk about B Corps or other corporations that are B Corps. We are also a proud B Corp. But thank you for joining me today. Today, we're going to talk about sustainable investing as a tool to combat climate change. Let's get down to brass tacks. So what are we going to talk about today? Well, we'll talk a little bit about my company, Envest Asset Management, and how we help our clients become better stewards of the environment through their investments. We'll do a brief history of sustainability. It's actually quite long, but we'll try to condense it down a little bit here. We're going to talk about how it's become an unstoppable movement. There's been tremendous growth and those trends behind that. We're going to talk about from why to why not. It used to be, why would you invest in sustainable companies? Now it's, why don't you? The research is pretty compelling. We're going to talk about what products are out there to align your values with your investments, or vice versa, really align your investments with your values. And then lastly, we'll do a little bit of lifestyle sustainability, maybe a few tricks, a few tips that you might not be aware of that we can show you at the end of this presentation here. So a little bit about Envest Asset Management. Well, we help individuals and families augment their portfolio to think about sustainability, really driving their finances to match their actual ethics. So that could be their individual accounts, their 401ks, their IRAs, their 403bs. We also help them with financial planning, making sure that they're maximizing their savings, their income, and really putting it to good use. We help businesses with their 401ks. We help set up 401ks. We help nonprofits set up their 403bs, but again, allowing their employees to add some sort of sustainability while they're investing for the future. And then we also do something a little bit different for our clients as well. For certain clients, we actually do alternative investments, but we actually find alternative investments, private investment opportunities to invest in that have high sustainability mandates. One more thing I'd like to mention about Envest Asset Management. We are completely independent. We don't work for a Charles Schwab or Fidelity or a Vanguard. We only work for our clients. We're fiduciary. We always have the best interests of our clients at heart at all times. Legally, we're bound to be like that. We are fee only. Only our clients pay us based off the advice that we give them. We don't pick up any commissions or any type of fee outside from our clients, meaning if I recommend a particular investment, I don't get paid by anybody to make that recommendation. I don't get a commission for doing that. So that's a little bit about what we do here at Envest. So let's talk a little bit about the brief history of sustainable investing. But before we go into history, let's do a quick definition of sustainability. Over the past few years, and maybe even the past couple of decades, you've probably heard words surrounding sustainability like socially responsible investing, social investing, sustainably, socially conscious investing, green investing, ethical investing, impact investing. So there's all these different definitions to help kind of quantify what sustainable investing is, or investing in a more, I'll call it conscientious way, would be. So the good news is, and this is kind of a trend, is a lot of people are just starting to call it sustainable investing. And the reason why is because really what we're trying to get at the heart of it is we want to be able to review companies that make some sort of quantifiable impact and actually quantify the impact that they're making. And in doing so, what we're trying to do is we're trying to stay away from those that pose costly risks. It could be costly in the sense that it impacts the environment in a bad way or society in a bad way, or it could actually be a physical expense to them in the future for impacting the environment or society in a certain way. And the way that we're seeing it today is through this lens of ESG, which stands for environmental, social, governance. Again, E for environment. How are we impacting the environment, the water resource, the land resource, the different resources that are needed to actually make a product and run a business? How are we impacting society, our neighbors, our employees, and are we treating them well? And G, for governance, how is the leadership of a corporation taking these and really steering the ship so that they're making a positive impact to society, to the environment? Are they helping their employees and really engaging the employees to push that, not only their corporate mission, but their agenda towards environmental and social causes? Okay, so we have a definition down about sustainability, but I want to back up to some key milestones in sustainable history. And here's a huge one. Back in 1970, I kid you not, this really happened. In New York Times, Milton Friedman, a famous economist from the University of Chicago, wrote a Friedman Doctrine. The social responsibility of a business is to increase its profits. And then he goes on to say, businessmen who talk this way, meaning talk about social responsibility in a business, are unwitting puppets of the intellectual forces that have been undermining the basis of a free society these past decades. So this was published in 1970, the New York Times. And he recognizes that corporations for decades have been thinking about social responsibility in their operations and how the impact of their operations have on society. And he goes on, he says, forget about that. What you need to worry about is increasing profits so that your shareholders make as much money as they can. So that's crazy. It really upended a lot of things. And I think now we're kind of steering the ship in the right direction. However, that gave corporations, probably a lot of corporations, I'll call it a moral license, right? A moral license to do whatever they needed to do to make profit. But let's move on. So something else happened in the 70s, which is pretty critical. And these are some key milestones around sustainability. So in the 1970s in general, there was the Vietnam War, and there was also civil rights at home that sparked a lot of activist investors. So in 1971, the very first sustainable fund was launched by Pax World, which was actually funded by two ministers. And they wanted to steer clear of investments that they were against ethically. So that was primarily driven by the Civil War. In 1972, in particular, another publication came out that actually listed socially responsible stocks. So those were really two key milestones in the 70s that really helped give sustainability and social responsible investing a boost throughout that decade. But let's kind of fast forward a little bit to the 1980s. So in the 1980s, again, there was this civil rights action, but instead of at home, it was abroad. And that was a huge step towards continuing the sustainability push. And a couple other big milestones that happened was in 1984, the U.S. Sustainable Investment Forum was founded. Again, a big push into sustainability. And in 1986, a big hammer. U.S. Congress passed an anti-apartheid act that actually banned investments in South Africa. So when you think about socially responsible businesses, that really put the hammer down from preventing businesses from entering business in South Africa. So that was 1986, but now we can kind of jump ahead again into the 1990s. Okay, so we made it through the 70s, we made it through the 80s. Let's move into the 90s. So what was the big push in the 90s to keep this sustainability momentum going? Well, in 1992, the UN actually held this summit, and they wanted to talk about economic development, not only because we want to grow the economy, but they thought about the intersection of development and environmental protection. It was really a way of understanding, okay, as you create new things, how can we continue to protect the environment? Because that didn't have a lot of consideration. So this helped mold that. And a big one came down in 1997, the Kyoto Protocol, which actually set forth goals to address climate change. And those countries that signed the Kyoto Protocol as part of it actually committed to reducing carbon emissions. So that was back in 1997. Okay, so let's move on to the 2000s. So what happened in the 2000s? Well, quite a lot, actually. So there's this organization that actually came up with this standard, the Global Reporting Initiative, that actually sets forth this way that businesses can now communicate their sustainability efforts. That was in 2000. Well, what else happened? In 2006, the UN launched this program called the Principles of Responsible Investing. It's for major investors to think about the impact their investments have on society and making sure that the investments that they make are more in line with these principles. There's 7 of them. The Global Impact Investing Network was launched, and this is really interesting. It was actually founded by the Rockefeller Foundation in 2011. There was the Sustainable Accounting Standards Board, which actually established a way to report ESG, kind of like you do for regular accounting. This has to do with sustainable accounting. And then in 2015, well, there was the Paris Climate Accord, and it brought together world leaders to help fight climate change and be on the path towards climate change. So that brings us to today, and really we're on an unstoppable movement when it comes to sustainability and sustainable investing. So before it was about the shareholder, well, now it's more about the stakeholder. And in that same article, Milton Friedman went on to say the only responsibility that a corporation has is to its shareholders. Well, that's totally being revised. It needs revision, and we're moving towards this stakeholderism. And that's really what the trend is going towards right now. Leadership wants a higher purpose. You can see over here the stakeholder cycle. They engage their employees to promote that purpose. They engage suppliers to that purpose and their partners. Customers are happier because you have a purpose. The company has a purpose. The community is being better served from your purpose. And investors are happier too because they're making more money, and the corporations that they're investing in are doing better because of the thought behind sustainability. And when you're thinking about sustainability and you're thinking about stakeholders, well, how can you think about your stakeholders? Well, you can think about it through this lens of ESG, environmental social governance again. We call that inclusionary. You think about waste, your energy, your water, your pollution. You think about social aspects of it, your suppliers, your community, your employees. You think about your governance, the transparency. You avoid conflicts of interest. Another key trend that people are talking about is long-termism, focusing capital on the long term. This was coined by McKinsey. Again, there's this idea of like industry-specific metrics to make yourself more valuable over the long term, but there's this huge component of sustainability metrics that use ESG. And just to quote a very famous, fairly famous CEO, he was the former CEO of Best Buy. He actually went on to say, if you believe the only thing for a company to do is generate shareholder value, you're going to be in big trouble. So this was Best Buy. Another key trend that we're seeing is divestment, which is really moving away or repositioning away from a specific business sector. We call that exclusionary. So that could be like fossil fuels, guns and military weapons, and other things. The reason why people want to divest, it could be a number of reasons, but one way of doing it, it actually raises the alarm to the corporation. It's a means towards engaging the corporation to get them to do what you want them to do. It can provoke that change. It's also a way to value a company. You might think ExxonMobil is worth $0, even though they have all these assets and they create all this revenue. You might say, well, over the long term, that's just not going to last, so let's get out of it. That's divesting. And another way you might want to divest, well, it just might not align with your ethics, just period. I mean, you might see that oil might be around for another 50 years or whatever and have value, but if you don't believe in oil and you don't want to pollute the earth, then you want to get out of oil. So those are some of the trends that we're seeing in sustainability today. And when we think about stakeholder engagement in the movement, well, what's the type of growth that's happening? Well, according to the US SIF Foundation, nearly $12 trillion is professionally managed that uses sustainable strategies. So that's 1 in every $4. And you can see this growth from 1995 all the way to 2018. This will be updated actually fairly soon, probably by the end of the year, beginning of next year. It's grown 18 times. That's how much the sustainable movement has kind of grown. 8.6 trillion dollars are managed for institutional investors that's geared towards sustainability, like your pension funds and your endowments. Another $3 trillion is managed for individual investors that focus on some sort of sustainability or use sustainability in their guidance when they're making investments. So that's like your retirement accounts, your 401ks, and your personal investment accounts. So this is a huge trend that's going on, and it's just been growing. And really, this trend includes both stakeholder strategies and also divestment strategies. So what's going on next? Well, when we look at the divestment space and the ESG, the stakeholder space, when you're divesting fossil fuels, we're talking 14.5 trillion of managed money has committed to divesting fossil fuels. And these are some of the biggest names that you could probably hear of. The University of California, the entire system of the University of California, that includes like University of California, LA, UC Berkeley, UC San Diego. The entire UC system is actually trying to divest away. This is the country of Ireland is actually divesting away. The Rockefellers, they have their own fund. They made their money on this type of stuff. They're divesting away. New York City, their pensions are divesting away. University of Cambridge, Georgetown University, Middlebury, Norwegian Sovereign Wealth Fund is over $1 trillion fund. They are divesting away. So what about people that are actually creating products that are focusing more on ESG as well, and not just divesting fossil fuels? Yeah, there's some of that too, but they're actually creating products to invest. Well, these are some of the biggest names that you can think of too. Vanguard, Fidelity, BlackRock, Invesco, State Street. These are all organizations. We spoke about this a little bit before, UNPRI, UN Principles of Responsible Investing. These are organizations that are actually creating products that we can use that are aligned with our ethics. So the UNPRI, there's over 3,000 signatories. These signatories actually manage nearly $90 trillion worth of assets. And just to kind of give you an idea of what that means, well, the world GDP, or the gross world product, if you want to call it that, was 88 trillion in 2018. These actually manage more than that. So you can just imagine the size and scope of what these people and what we can do in the sustainability space if we continue down this path. Oh, just to hammer it home, $14.5 trillion divesting from fossil fuels. I mean, that's huge. These are real players. They say, hey, listen, we don't want to be a part of it anymore. You guys are harming the environment. Let's do something about it. So that's a lot of money that's being divested away from the fossil fuel space. With all the steam that's being generated in the sustainability space, you can kind of see that the old thought of why would you invest sustainably is now shifting to why aren't you investing sustainably? And let's talk a little bit about the performance and resilience of it. And these are just two quick studies that I pulled up. The first one right here is really performance-based. Calvert, which owns and manages a bunch of sustainably focused funds, they said, okay, well, if we take the top 20% that we score on ESG and compare it to the bottom 20%, you can see that it's actually double in performance from a monetary standpoint. Morgan Stanley actually did this study not too long ago, and they went on to say something to the effect of, okay, well, we can't really tell the difference between a sustainable fund and a traditional fund. So the performance is relatively the same. But they went on to say, however, there's less downside risk in a sustainable fund, which they found, compared to a traditional fund. So we would call that higher risk-adjusted return. If I can get the same return as a traditional fund, yet if things start going bad, my value doesn't drop as much, I'd take that all day. That's better risk-adjusted return. So what about the broader market compared to the energy sector? And energy sector really involves this fossil fuels, like your oils and your gases. Well, you can actually see year to date, even with this huge dip because of COVID, the market is still up 6.7%. On the other hand, fossil fuels, oil market, the energy market is down 48%. And if you look at it even a longer term, 10 years, the market's up 228% compared to fossil fuels, which is down 38%. So to me, it's like, yeah, let's get away from fossil fuels. So how can we align your investments with your ethics? How can you join this movement towards sustainability? Because you've seen that it's grown quite a lot. Well, as an individual, you really have a lot of options. Let's say you have an IRA or a personal account. Well, sustainability focused funds started way back in 1971. We already discussed that with Pax World and two ministers. Since then, there's been tremendous growth. And in 2020 alone, there's been over 150 new sustainable funds launched. So there's a lot of options out there. And just let's take a look at this growth here. So in 1970s, you can see it coming along. These are MF stands for mutual funds. And you can see how many funds that were launched every year. And on the ETF side, you can see really like mid, early 2000s, you could see a bunch of sustainably focused mutual funds as well being launched. And cumulatively, you can see over time that there's nearly 1,000, definitely over 900 sustainably focused funds that you can use to align your investments with your ethics. And the options abound. There's large size, there's mid size, there's small size. So that you can invest in the largest companies, mid-sized companies, small companies through mutual funds and ETFs. You can invest in large foreign markets. You can invest in emerging markets like Latin America or India. You can invest in water-focused funds. You can invest in clean energy-focused funds, UN SDG-focused funds, the UN Sustainable Development Goals, which we did not talk about, but is used a lot in sustainable investing. You can do electric vehicle focused funds. You could do battery focused funds. You can do religion focused funds. And you could do low carbon and fossil free funds as well. So who's really organizing and ranking sustainability? Everybody kind of has their own thing, but here are some of the bigger ones. Sustainalytics and Morningstar, Morningstar actually owns Sustainalytics. They use a program that helps rank sustainable companies. Dow Jones Sustainable Indices, which is part of Standard & Poor's, makes one. MSCI, which is owned by Morgan Stanley, they make these indices that actually help rank corporations on sustainability measures. But there's a lot out there that have sustainability mandates. But I have to tell you, and this is a big warning, there's not one single organization that verifies that a mutual fund or an ETF is sustainable. It is a self-designation, which is why you really need to read what the fund's purpose is, and you have to look at the fund itself to determine whether or not it's within your ethics and if it really is sustainable. That's a big thing. These tools over here, Sustainalytics, Morningstar, Dow Jones, and MSCI, they help rank these. They're not the ones that say, yes, it's sustainable. It is a self-designation, so you really got to look into that. But from a personal standpoint, there are a lot of options out there for you. So what about a business standpoint? For your 401ks, your 403bs, your 457 plans? Well, if you're an employee, you'll actually have to look what's offered within the plan. And then if you look with what's offered within the plan, you can go to this organization, As You Sow Invest in Your Values, and you can run through and determine if what is offered is in line with your ethics, and you can kind of compare which ones are better within the confines of your plan. So there's usually a ticker symbol. It might be 4 or 5, letters long, maybe or so, and you can actually see. And I pulled one up, which may or may not be in your plan. Ticker symbol is FXAIX. It's the Fidelity S&P 500 Index. And if you look at it from the lens of a fossil-free fund, it gets a C. And the reason why is because it's got $16.8 billion focused in fossil fuel investments. And As You Sow actually breaks it down for you. 15 holdings are in top 200 owners of carbon reserves. One holding in coal industry, oil and gas industry, 26 holdings, $6 billion. So you can actually see how these align with your ethics if you go to As You Sow. Now, if you're a business owner and you offer these plans, or if you're a nonprofit that offer these plans, you could actually augment your plan when you speak to your financial advisor, whoever you work with, to find better options that have, I'll call it, higher sustainability measures to it. So that's how you can get investing more sustainably for you as an employee in a business, or the business itself can actually augment the plan. So let's just kind of take a look at what a big difference sustainability is compared to a more traditional plan. So this is something that I kind of pulled together. And a more sustainable portfolio, the amount that a traditional portfolio might have is 5% or more in fossil fuels. I've seen stuff as high as 15% or more. But you can get down to, below 3%. So you could be at 5 before, you could be down to 3. And in reality is you could really get really low, below 1%. It's just a matter of tailoring it to whatever you want. Another big one is thermal coal. You might be at 2%, now you're down to 1%. A lot of people, particularly against thermal coal because of obviously the emissions that it has. Small firearms, SA, that's low to begin with, but you can get even lower, and in certain cases you can even go down to 0. Palm oil is a big one when it comes to deforestation. Palm oil might, corporations that use palm oil might be above 1%. You can get it down to nearly 0. So that's the power of sustainability, and this is through the exclusionary method. What we do is we exclude what we call sin sector, right? And you really lower the amount that you have in these sin sectors. You might see some that are a little bit higher. AT is animal testing. The portfolio that I put together, this talks about, it uses a lot of pharmaceutical, which you can imagine nowadays pharmaceuticals ramping up because of the pandemic. You might want to be a little bit overweighted in that. AC, abortive contraceptives, again, if particularly when it comes to religious purposes, this is a little bit higher, but again, this kind of goes in line with pharmaceuticals. So you might see those be a little bit higher, but it really depends on the individual. You can work these down. So what about carbon footprint? Well, I want to show you this graphic because there's a few things that I'd like to talk about. The first is the power of compounding. By putting in, let's just say, $225 a month at an 8% return every year, over 46 years, that turns into, over $1 million portfolio. But what's the carbon footprint of that? So we're happy, over 45 years, which is very achievable. Let's say you start doing this when you're 25, you retire at your 70, right? That's 45 years, 46 years, 70, 71. Well, under a traditional portfolio, your lifetime tonnage over that same period of time, 1,200 tons. 1,200 tons, that's metric tons, by the way. That's equivalent to 2.8 million pounds. If you look at the difference, though, the gray is the traditional portfolio. You look at the difference of a sustainable portfolio, you're talking only 527 tons. So that's 1.2 million pounds. That is greater than a 50% difference, by going into a sustainable portfolio. That is huge. That's 1.6 million pounds difference of less carbon dioxide in your portfolio. So that's really the power of sustainable investing. Part of it is reducing your own personal carbon footprint through your investments. Okay, so before we adjourn, I want to talk a little bit about some parting thoughts, some lifestyle sustainability. This is a product of what I used to do. I was a private equity investor in the renewable energy space before I started my own company, focusing on sustainable investing. And what I want to talk about is lifestyle sustainability when it comes to energy efficiency and renewable energy. So there is an organization through NC State. It's called desireusa.org. And they actually compile all these state programs that help you become more energy efficient. And by the way, not only just state, but federal programs too. So if you live in Connecticut, if you're not familiar with Energize CT, which now you are, you can Google Energize CT. But if you live in any particular state, you can go to Desire, click on the state, and it'll bring you up to the policies that help promote energy efficiency and renewable energy within your state. And that'll actually help you determine whether or not you want to move forward with a project in your home or your business, right? Because you might be saving money and be getting a grant or a low interest loan. I also want to talk a little bit about some of my favorite blogs and organizations. So obviously Connecticut Sustainable Business Council, Conscious Capitalism Connecticut are two organizations that I like. But Yale Climate Connections, they do this 2 minute pod every single day, and it talks about how people are making a difference in sustainability. ISSP, the International Society of Sustainable Professionals. Again, they bring together sustainable professionals throughout the entire world to discuss ways to become more sustainable. World Economic Forum, they have great pieces on sustainability and just about, global events in general. It's some of those things are really are actually very addictive. And then one of my favorite blogs, my buddy does it. It's Crowdsourcing Sustainability. He's got maybe over 100,000 people that read his content on a weekly basis. He actually blogs a lot about what's going on throughout the world and sustainability as well. So with that, some things that you can do. You can act today. You can check your portfolio for divesting in fossil fuels. You can do stakeholder engagement to align with your ethics. You can invest in companies and industries that are really critical for our future, like water, clean energy, things like that. You can actually do other things as well, like vote, which is coming up very soon. You can vote based off of your values. These are all individual things in your own personal portfolio. When it comes to your business's account, your employee retirement account, like your 401k, your 403b, your 457, you can talk to your employer about your options. You actually have other options too. You can actually transfer funds out of there, but that takes a little bit more work. But you can talk to your employer about options. You can use as you sow to see what options that are in your current plan and see which ones better align with your ethics. So thank you so much for joining me today. Thank you for making a difference. I can't wait to talk to you a little bit more on the Q&A session. And thanks again.